Hello, fellow rebel capitalists. Hope you're well. So, the stock market down big again today as the volatility continues. Retail sales out. I think that might have something to do with it, along from what we're hearing, or along with what we're hearing from some of these huge U.S. corporations that are revising their expectations for the rest of 2025, not just down, but their expectations are plummeting. So let's get into that right now. First and foremost, let's kind of get an overview of what happened in the markets. We'll go over to Bloomberg. And in percentage terms, the NASDAQ was down the most, about 500 points, down about 3%. I think the Dow was down about 700, something like that. But in percentage terms, a little less. And one of the big things that was dragging the NASDAQ down was NVIDIA. They plummeted. I think it was because of some additional charge, like a $5 billion charge that they kind of came out of blue. They weren't expecting that they got hit from China. And it might have to do with these retaliatory tariffs, something like that. I'm not exactly sure. But the big reason the NASDAQ is down today is because of NVIDIA. At least that's the story. That's the narrative. But when you look at the retail sales and everything else that's going on, I'm not sure it was exclusively about NVIDIA. So let's go over to what happened with retail sales. And they actually increased. It was greater than expected. So I know a lot of you right about now are saying to yourself, okay, George, well, this doesn't make a lot of sense because you're trying to maybe connect these dots and say maybe it was the retail sales or what's happening with the U.S. economy that is bringing down markets today, right? But let's think this one through. So the expectations were for 1.2%. Now we got 1.4%, but February was 0.2. So why were the expectations 1.2? My guess, and I haven't even read this article, so we'll get into it here in real time, but my guess is it's front-running tariffs. It's all about front-running tariffs. So if that's the case, it's not about, woohoo, 1.4%. And by the way, that's not adjusted for inflation. It's, okay, 1.4%, but we're still really walking on thin ice. Because what I'm really or what I'm waiting for is what the retail sales numbers look like once we get into the tariff regime, we'll call it, where you're not pulling forward all of this demand. But key talking points, like we said, 1.4.
You're not sharing your screen.
Shoot. Well, that would help, wouldn't it, guys? I'm sitting here rambling on about all these statistics and numbers and going to them. See, I had this thing all planned out, guys. It was so nice. Look at this. I had this chart pulled up for you guys of the NASDAQ. I had all these headlines. I went right over here to retail sales headlines. I was going through these key talking points as if you can see them. And you can't, or you couldn't. So that's a big fail, a big L for George on the first video of the day. All right. Moving on, excluding autos, the numbers also were stronger than expected. Okay, up 0.5 with a 0.3 forecast. Consumer spending was stronger, got it. Advanced estimates, okay. Let's see if they give any explanation. My gut's telling me this is demand pulled forward. I mean, I'm not in the United States, but if I was, and all I'm hearing is prices are going up, prices are going up, prices are going up, tariff, 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 tariff. And I'm just the average Georgian. I'm like, okay, well, if I'm going to buy a car, I might as well buy it now. Or if I'm going to buy a TV or whatever, I might as well buy it now. Here we go. Net. These are simply blowout numbers on March retail sales where the rush is on. Like this is one gigantic clearance sale. Yeah. This is what I think too. This is Chris Rupke, chief economist of Forward Bonds. Here's another quote. Consumers are expecting sharply higher prices the next year and are clearing the stores' shelves, picking up bargains while they can. Yeah, and they reference the Michigan survey right here, University of Michigan survey. And a lot of people, probably rightfully poke fun at this survey because the Democrats are just hair on fire, hair on fire, hair on fire. In fact, I think the forward expectations for inflation on the Democrat side for 2025 is like 6.7%, something like that, even though we're at 2.4 right now in the CPI, and we had a negative month over month number. So they're out there, hair on fire, hair on fire, hair on fire. But the bottom line is, even if you want to poke fun at them, if they believe that we're going into the greatest inflation that we've had since the 1970s, because that's what they hear on CNN or MSNBC or whatever it is, they're going to pull demand forward. Regardless of why they're doing it, most likely they are doing it, which is what you have to know when you're trying to figure out what this blowout number actually means, and is it a blowout number? And if it is demand being pulled forward, well, what does that mean for the next month? That means there's less demand than there otherwise would have been. Same thing for the 6 months looking forward. So last week, the closely watched University of Michigan's consumer survey posted second lowest reading. So this is what they're juxtaposing the two and saying, this doesn't make sense because the consumer is really worried about the economy, worried about their job. Consumer sentiment is down, but yet they're out there doing all this spending. Okay, well, when you look at those two things together, what does that tell you? It's all about just demand being brought forward because of tariffs. And I'm not saying that's why the market went down today, but I think it could have been a contributing factor that no one's really talking about. Let's read what the big movers were here. Aside from big move in auto-related sales, sporting goods, hobby, music stores, while building material and garden stores, food and service, drinking up one. Yeah, see. Yeah. So basically what's happening here is the stuff that you can't stockpile. That really didn't add too much to it. In fact, that like food services and drinking places were up 1.8%. So I guess that did contribute to the upside, but it wasn't near as much as the stuff that you can stockpile, which would be auto-related sales, sporting goods, hobby, music stores, material, garden stores, etc. And then, as you guys know, one of the main reasons we saw a 2.4 print on the CPI is to the point here. The gas stations reporting a 2.5% decline as prices fell during the month. Again, why are these prices not real? Why are they not adjusted for inflation? That doesn't make any sense. But I guess it is what it is. So now let's go over to maybe some other reasons that we're hearing from these big mega corporations as to why we're seeing a lot of volatility here and why the underlying fundamentals of the economy may be weak, not because of the tariffs, but it may be weak even regardless of the tariffs, and the tariffs are just kind of adding fuel to the fire. Let me show you what I'm talking about. Right here, United. This is from yesterday. United cut flights as domestic demand disappoints, but international and premium travel drives profits. So high-end consumers still doing fine, but it's not that they're seeing a reduction in domestic demand. They're seeing such a reduction that they're actually cutting flights. This is United. And we heard something similar from Delta as well. And I don't want to go too far into a CNN article, but you get it from the title here. Delta warns of economic uncertainty and stalled growth in new recession alarm bell. So it's not just the demand being pulled forward stuff. It's what you're hearing from kind of these corporations that I would consider bellwethers for the economy, airlines, a FedEx, we're hearing the exact same thing from them, that the freight travel, the freight moving back and forth has really been declining, and that's exactly what you would see in an economic contraction. Now, that said, one of the things I went over on today's whiteboard video, it'll be out today, is the labor market. In my view, it's all about the labor market. And if you look at this indicator, I don't know that we went over this on a live stream. I kind of get the live streams and the whiteboards confused a little bit, so forgive me, guys. But the Fed came out with a report, and I thought this was really interesting. This was January 14th. And what they're doing is they're actually back testing to see if initial jobless claims is a helpful gauge or a helpful barometer for the health of the labor market and therefore the health of the economy. And is this kind of a quote unquote recession indicator? Well, it turns out it's very good. It might be, and see, what's cool about the yield curve is it tells you how these big financial institutions are positioning their balance sheet. And this tells you through their actions, not their words, what they think of the risk that's in the global economy or maybe in the US economy. But unfortunately, with the yield curve, it doesn't really help us as far as timing because it inverts and then nothing usually happens. And like we saw, it's inverted for 2 years. Same thing happened prior to the GFC. And then it uninverts, and that doesn't necessarily mean that the stuff immediately hits the fan. It's just another warning sign that tells you if this cycle, that's a big if. Again, we're dealing with probabilities, not certainties. But if this cycle is similar to past cycles, then we're getting a hell of a lot closer to the stuff hitting the fan than we were, when the curve was inverted. But outside of the SOM rule, and that's just basically the unemployment rate spiking about 50 basis points higher than its lowest point over the past 12 months. But this, I think, when you add it to the mix of every other one of these kind of recession indicators we have, you can get it can be pretty powerful as far as the timing. So check this out. Realized initial jobless claims relative to the optimal threshold. So what they did is they did all this back testing, and they showed that at 400,000, when you're over that threshold, you are almost always in a recession. Not that the recession is getting close. You can pretty much say you're in it. And so I think if we combine this with the curves that we have, the yield curves, we combine this with just the unemployment rate itself, and then you look at that 400,000 threshold, and right now, just FYI, we're about 225, which is very low. I mean, you can see right here, this black dotted line. It's historic. I mean, you've got to go all the way back to, I would assume they adjust this for population. I mean, they have to. They have to. I mean, I'm not, the PhDs at the Fed aren't the sharpest tools in the shed, but they're at least that sharp, for heaven's sakes. So anyway, assuming they adjust for population, we have not seen levels this low since the 1960s. 1960s. Well, I guess we were there just prior to the cerveza sickness. But the main point here is when we get above this 400,000, that's when the alarm bells should be ringing, especially if it's during a Fed rate cutting cycle. The curve is steepened out, and you're seeing unemployment spike as well. That's pretty much game on. But I think what we also have to pay attention to is the direction, because it's not just getting over 400,000. It's what's the trend doing. because you can see this trend going parabolic right here. And you could have got some good intel from that prior to it hitting that 400,000 threshold. But one of the things I talked about tonight's whiteboard videos, I think it's important. This is one of the things that I'm going to add to my toolkit. Going back to yesterday's video, but I'm going to add this to the George Gammon, the Rebel Capitalist toolkit for determining and trying to time an actual recession or economic contraction. So we see a lot of data. I think I went over this also. Yeah, I think I went over this in the whiteboard as well. The New York Fed came out with the manufacturing survey, and bottom line is expectations haven't been this low since 9/11. 9/11. And this is not the consumers and the Democrats that are just watching CNN. These are the producers. This is a manufacturing survey. So it wasn't this low during the survey sickness, nor was it this low during the depths of the GFC. So I'm not going to go over all the charts from tonight's whiteboard video. You guys are going to have to watch the video itself. I can't give away too much here. But the bottom line is there are a lot of indicators that are pointing to an economic slowdown. But I think the key to timing it is going to be the labor market. Okay, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. And we'll see you on the next video.